Hello, Chino's board members.
My name is Zach Rosa.
And I'm Zach Coughlin.
My name is Kyle Saunders.
I'm Brooke Wells.
And my name is Lynette Fowler, and we are business valuation staff at Investment Bankers, LLC. We would like to thank you for your time and consideration. Per your request, we have performed an evaluation of your firm and the options your firm has on the table moving forward. We assess the various options presented by the board using a variation of economic, financial statement, industry, and valuation model analysis. With all of these factors and considerations, we provided our recommendations for the following questions asked of us. Our thoughts on ATL's capital bid versus our estimated value. If we were to sell, what are our recommendations in going about this? What are your alternatives to selling the business? And what is potentially the best proposal that satisfies current management, shareholders, and is best for the company? Brooke will be reviewing the historical and current economic data.
In any business deal or proposal, it is important to look at the overall economy. This is important because all businesses are affected by economic factors such as population, unemployment rate, GDP, and many other factors. Examining the state of the economy can provide investors or business managers with relevant information needed to achieve maximum growth. There was very little growth in the economy in 2012 due to the uncertainty accompanying the upcoming presidential election. During 2012, the government was in a situation of gridlock, a situation when it is very difficult to enact legislation to help the needs of the people. This was due to the makeup of Congress, which led to the political statements and inability of Congress to work across the aisle. The economy was still recovering from the 2008 recession and financial crisis. In 2012, the U.S. stock market was not performing to its capabilities due to the upcoming election and the uncertainty it may bring with increasing taxes and spending cuts. During this time, the U.S. stock market was still one of the most appealing markets for investors compared to the other countries. This was because markets like Europe and China were just barely recovering from the recession that occurred back in 2008. Although there was uncertainty, the stock market still saw gains throughout the year with an average increase of 12.98%. Growth from 2009 to 2010 shows a positive outlook in the recovery from the recession, but the growth from 2010 to 2011 plateaued, which may represent over-aggressive growth in the previous year. During the period of 2012, there was about 313 million people living in the United States. As the population grows, it creates more opportunities for the economy to grow, with more people that could potentially mean more spending that is occurring. This graph shows the unemployment rate from 2009 to 2012. On the x-axis, we have the year. On the y-axis, we have the unemployment rate. And on this graph, we have the GDP per capita from 2009 to 2012. On the x-axis, we again have the year. And on the y-axis, we have the GDP per capita in US dollars. One major factor of the growth of the economy is the unemployment rate. This is a percentage that comes after changes in the economy rather than something to predict change. When the unemployment rate is a high, that signifies stagnant or falling economy with little to no growth. Then when it is low, it means that the market is stronger and growing, creating more job opportunities. In this graph, you can see that in 2012, the unemployment rate was very high at 7.8%, which is down from 9.4% in 2010, right after the market crashed. It is projected that this will drop, which is a good sign coming from the economy. The unemployment rate is a major factor considered by Federal Reserve, and it plays into interest rates as well. The federal funds rate is an interest rate at which commercial banks can lend immediate funds from the Federal Reserve. The feds try and keep this rate as close to zero as possible, especially when there are high unemployment rates. In 2012, the interest rates were ranging from 0 to 0.25%. As projected, unemployment rates will fall, resulting in feds raising the rate. This will be the first time that rate would increase since about 7 years ago. This is important to note because this means that the economy is finally growing to an amount that the Fed is willing to recognize the growth and make changes. On the other side of this spectrum is the GDP, a measurement that can allow you to project certain changes in the economy. As you can see in this chart, there has been a steady increase in GDP per capita. From 2010, around 48,000 to 2012, around 51,000. This increase just represents that the U.S. produced more, showing the economy is moving to a healthier, more stable level. GDP goes hand in hand with a couple of other variables, of which include disposable income and consumer spending. These two economic factors are very similar. When consumers have more disposable income, they typically spend more money on recreational items. This is important for a business like Chino's, which is in the retail business. An increase in disposable income would also represent an increase in consumer spending. Consumer spending is calculated at 70% of GDP. Since the GDP is steadily increasing from 2010 to 2012, that means that the consumer spending has a constant increase as well. This is significant because it is showing how the economy is growing. When the consumer spending and disposable income increase, there is a positive correlation between that and the consumer confidence. This measures the degree of optimism that the consumer feels about the overall state of the economy and their personal financial situation. The higher the better, meaning that in the near future, a consumer will typically spend more money than save. They will spend more money because they have a higher level of optimism that they will hold a good job for a longer period of time. In 2010, consumer spending was at 53.3. Then in 2012, it was at 66.7. This is showing that in the eyes of the consumer, the economy is moving in a positive direction. This increased outlook in consumer confidence and spending has a significant impact on the growth potential for Chino's, as Zach will show in his analysis. Inflation rates are a key factor as well. This shows that the general level of prices for goods and services, the higher the inflation rate, the more money the one object will cost over the course of a year. In 2010, the inflation rate was at 0.34 and increased to 2.1 in 2012. The long-term inflation rate is consistent at 2%. The inflation rate is related to consumer spending and disposable income because it allows the consumer to have a better idea of their purchasing power. Even though in 2012 the market did not perform at a rate that would be ideal for the ideal growth in the following years, but there is a lot of potential and upward pressure in the economy to outperform previous years. The growth can be explained with the unemployment rate dropping significantly from 2010 to 2012 to a point that it is an all-time low. The GDP rising, signifying growth, the different aspects I just talked about. Analysts believe there will be growth at a steady rate in the coming years. This growth will push the economy to recover from the 2008 recession as we continue to see a bull market run year after year.
Moving into the analysis of the financial statements, we're going to start with the balance sheet. For assets and liabilities, Chino's currently has assets of $72,792,000, which is up from $62,808,000 in 2011. Their liquid assets, which are cash equivalents, and accounts receivable, account for $33,454,000 of the $72,792,000 in 2012. To put that into some comprehensive ratios, your current ratio is 1.86 to 1, which means that you currently have $1.86 in current assets for every $1 in current liabilities. Your quick ratio, which accounts for the cash equivalents, and accounts receivable, is 0.85 to 1, which means you currently have 85 cents in quick or liquid assets for every $1 in current liabilities. Some other significant ratios are inventory turnover and receivables turnover. Inventory turnover is 19.18 times, and this accounts for the average inventory between 2011 and 2012. This means that inventory is turned over roughly 19 times per year, being held for about 19 days on average. And receivables turnover is 24.82 times. Receivables are turned over roughly 25 times per year and remain unpaid for about 14 days. So moving into the income statements, this is the income statement highlights if Chinos would remain a standalone company. For revenue, in 2012, Chinos generated $585,233,000 in revenues, which is an 8.64% decline from 2011. With the overall economic outlook, the projections for the recovery of this decline seem reasonable. The 5-year projections are optimistic, but they show revenues continuing a decline into 2013, but recovering fully by 2016. Further growth is expected beyond this. In terms of EBITDA, it was 4.59% as a percentage of sales. This is a 2% decrease from the previous year, but is expected to recover within 5 years. The next 2 slides will display the general trend for both net income and gross profit.
On the graph here, we have the gross profit trend as a standalone company. On the x-axis, we have years going from 2011 to 2012 actual and 2013 to 2017 projected. And on the y-axis, we have gross profit as a percentage of sales. The gross profit is projected to keep within a 5% range as a percentage of sales. And the present decline in 2012 is also expected to recover by 2016 and see some minimal growth in 2017. So as you can see, the pit of this graph is right here in 2012. This is its lowest point, and it's projected to rise in 2013 and onward into 2016, where it's going to plateau, but it's still at a slight increase. On the graph here, you can see net income as a percentage of sales as a standalone company. On the x-axis here is years. 2011 and 2012 are actual, and 2013 to 2017 are projected. On the y-axis, we have net income as a percentage of sales. Net income has seen its lowest point in 2012 here, but as sales increase into 2014, net income will follow suit. With the general consistency of 2011 to projected margins, the net income appears volatile in 2012. However, the percent change in net income is consistent with the percent change in gross profit on the previous graph.
Next, we'll cover some income statement highlights if Chinos were to be acquired by a private equity fund. Some synergies were expected resulting from an acquisition, specifically from the offer by ATL. These synergies were estimated at $2 million per year, which we believe may be optimistic as well. The figures in the next slide are based on conservative estimates of $1 million per year in cost savings, subject to fluctuation in sales.
So here we have a net income trend comparison. The area graph here in front represents the net income as a percentage of sales as a standalone company, and the area graph that is lighter in the back represents a net income as a percentage of sales if acquired. On the x-axis, we have years. 2011 and 2012 are actual, and 2013 to 2017 are projected. On the y-axis, we have net income as a percentage of sales. The net income between being acquired and remaining a standalone company is fairly comparable. The cost savings synergies provide less than 1% increase in net income year to year. And you can see that just in these sections here. It levels out around 2013-2014.
Looking at some highlights coming from the income statement if Chinos were to go private, cost savings of $3 million in public costs would be expected in years projected going forward. This would provide its most benefit in the first several years of being private. Based on projections, the benefit of net income would diminish by 0.1% each year from its peak benefit of 0.4% in net income in the first year.
This is a comparison of Chinos to other companies. There are 2 important notes to make to preface this slide. Company 4 and Company 9 were excluded from consideration as our team believed that these companies were outliers with significantly more revenue and net income than Chinos. The other note is that we believe these companies are missing information that would be pertinent to the comparison. The information received was solely quantitative. The presence of qualitative factors would be useful when comparing. It would be beneficial to know which line of business these companies are in, as well as their quality of management, product lines, and geographic market. At any rate, this is the comparison of Chinos to other companies provided. The market cap and enterprise value were calculated for every firm. The only company with a smaller market cap was Company 3. Every company had an enterprise value in the billions except for Company 3, Company 8, and Chinos. It is important to note that the calculated enterprise value for Chinos was $165,623,000, with the bid from ATL Capital being around $200 million. The EV to sales looks promising for Chinos as there is a large amount of revenue in regards to enterprise value. Chinos has the lowest EV to sales when comparing to all of the other companies. The enterprise multiple for all of the firms is below 10, except for Company 6 and Company 8, which indicates good health out of Chinos than the other firms. The enterprise multiple of 6.14 is lower than that of the 7.5 times from Chinos' competitors. This can indicate that Chinos is potentially undervalued. The earnings yield is indicated by the percentage at the bottom row for every company. Chinos has the second lowest earnings yield out of the companies. In summation, the other companies are larger than Chinos and have a better earnings yield, but Chinos appears to be undervalued with a potential to grow.
Now we must use the information given in Chinos' financial statements to come up with a valuation for the company. And to do that, we'll use the income method to come up with a valuation. The first thing we did was come up with 3 different profit and loss statements for 3 different possible scenarios we can forecast happening. We have conservative projections, moderate projections, and optimistic projections for the company. The projections Chinos gave us we feel are optimistic, so our optimistic projections are the ones given to us by Chinos, while the rest we estimated based on the CEO's 2014 projected EBITDA versus the CFO's 2014 projected EBITDA, which differ by $10 million. As we can see in our conservative profit and loss projections, we used a 2014 projected EBITDA of $25 million, and we projected growth of sales from 2015 to 2017 at 2%, with 1% growth in 2018. We adjusted cost of sales based on numbers from prior years, and we used a 40% tax rate to arrive at our tax expense numbers, and this is also based off prior year numbers given to us by Chinos. As seen in this profit and loss statement, net income fluctuates from 2014 on, but ultimately our conservative projections give us a bleak outlook for Chinos. Let us now look at the moderate profit and loss projections that we have come up with for Chinos. For these projections, we used $30 million in EBITDA for 2014 and used a growth rate for sales of 4% from 2015 to 2017, with growth decreasing to 2% in 2018. Once again, cost of sales and tax expense are based off prior years. Net income still fluctuates a bit from 2014 to 2018, but it tends to be more stable than the net income found in our conservative projections. Our final projections are the most optimistic ones, and these are the projections given to us by Chinos using an EBITDA of $35 million for 2014 and sales growth rate of 6% for 2014 to 2017, with growth dropping to 4% in 2018. Net income for these projections grows at a pretty steady rate, which bodes well for Chinos. For the next couple of slides, we'll be showing the work done for our optimistic projections to determine the estimated value of the company, but just know that this work has been done for all 3 scenarios, and the values given at the end of this part will reflect the work done for all scenarios. Now, for our valuation of the company, we must first find earnings before interest after taxes for all years, which is shown in our projected profit and loss statements for each scenario. As we can see, for our optimistic projections, that will be $15,040,000 for 2014, $21,404,000 for 2015, and so on. We will use earnings before interest after tax to calculate our free cash flow for each year. Using the numbers in our optimistic projections, we can calculate net operating working capital, which is used to find free cash flow. First, we divide current liabilities and subtract out current maturities, and we take this number and divide it by total current assets to get our net operating working capital for 2011 to 2013. Next, we need to find net operating working capital for years we don't have balance sheet number for. And to do this, we need to find the average percentage of net operating working capital to sales throughout the first 3 years. We then take this number and multiply it by sales, which gives us projected net operating working capital for years 2014 to 2018. Now we have net operating working capital for 2011 to 2018, which allows us to now calculate free cash flow for all years. Now it is time to calculate free cash flow for each year, which is essential in finding our estimated value for Chinos. First, we take earnings before interest after tax and add back depreciation and amortization. Next, we must find the change in net operating working capital for each year and add or subtract these numbers depending on whether the change was positive or negative. Finally, we subtract capital expenditures, and with that we arrive at our free cash flow numbers for each year, which is highlighted in yellow. For scenarios where we want to account for cost-saving synergies and the cost of being public, we will add those numbers back into free cash flow after capital expenditures. Our next objective is to calculate the cost of equity, and to find this we use 2 different models, the build-up model and the capital asset pricing model. For the build-up model, we first take the risk-free rate, which is based off the 20-year U.S. Treasury rate of December 31st, 2012. We then add the long-term risk premium, which is given to us with the other statistics provided for comparable companies. We then add in the size risk and industry risk premiums, which are found in the Ibbotson Stocks, Bonds, Bills, and Inflation Yearbook from 2013. When we add these all up, we get a cost of equity of 13.82% using the build-up model. Now, when we use the capital assets pricing model, we must first relever beta. We relever beta by first finding the mean and median unlevered betas of comparable companies, which are given to us by you. We must then take the debt to equity ratio and adjust it for taxes, and then take this number and multiply it by the unlevered betas. We then average out the levered betas we have found, which are equally weighted, to get our beta number for the capital asset pricing model. Going back to our previous slide, we now have our relevered beta, which we multiply by the equity risk premium to get our beta adjusted equity risk premium. We then add that number with the risk-free rate to get a cost of equity of 17.07% using the capital asset pricing model. We decided to weight these models equally, and when we do this, we get a final cost of equity of 15.44%. We must now find the cost of debt. We do this by first finding the debt for each year. Then, we divide interest expense by our debt each year to get our annual cost of debt per year. For years 2014 to 2018, years for which we have no balance sheet statements to find the debt, we must estimate, and we did this by finding the average debt per year relative to sales, which is 9.498%, and using that number to estimate debt for these years. Then, once we had our cost of debt for each year, we averaged out the cost of debt for all years to get a final cost of debt of 5.10%. We then use our calculated cost of debt and cost of equity to find our weighted average cost of capital. We used 85% as our weighted cost of equity and 15% as our weight of cost of debt because these weights are very similar to the weights used by comparable companies. Using these weights and our cost of equity and debt, we are able to calculate our weighted average cost of capital, which figures out to be 12.20%. This number is important as it will be used as a discount rate when figuring out the net present values for our different scenarios. Now that we have weighted average cost of capital and free cash flows for each year, we're able to calculate the net present value of Chinos for each projected scenario we have given. These first three projections are values if Chinos were to continue to run as is within each of our three projected scenarios. As we can see, the optimistic approach gives us a value of $316,418,000, way above the offer price given by ATL Investments, while our other two projections are given below that offer price given by ATL. We then look at our estimated values when we include cost-saving synergies. As we can see, the optimistic approach still brings us to a value way over the offer price, but the moderate projections value is now very similar to the offer price given to us, while the conservative estimated value is still way under the offer price. Now we have estimated values if we include cost-saving synergies and the savings if Chino decides to go private. In these three scenarios, the offer price is below the value if we go with our optimistic and moderate approaches, while our conservative projections are still below the offer price, though it is closer than it was before. To find a final estimated value, we took the average of the three different projections for each of the conservative, moderate, and optimistic projections and weighted them based off what we feel are the scenarios that are likely to happen. We decided to go with a 35% weight for the conservative projection, a 40% weight for the moderate projection, and a 25% weight for the optimistic projection. We came up with these numbers based off economic factors, industry factors, and specific factors related to Chinos itself. In the end, we came up with a final estimated value of $211,660,000.
Based on our evaluation, we have decided the following. First, in terms of pursuing the sale, we recommend that you broaden your process to include other offers because it is evident that ATL, with their relatively high offer according to our valuations, intended to implement an aggressive growth strategy following the purchase. Second, it is possible that other private equity funds could see similar or greater potential in Chinos. Third, your alternatives to selling the company are going private, which would require an equity buyout, and remaining a standalone business. Due to the concern that ATL is viewed as a hostile takeover, the bid from ATL should not be ignored. Remaining a standalone business may require a stock buyback to prevent the hostile takeover. With the available cash Chinos has at current stock prices, Chinos could buy back 1.67 million shares, and depending on Chinos' current management holdings, that may be sufficient to maintain 51% control of the company. Lastly, if the bid from ATL is taken, we believe that ATL will implement an aggressive growth strategy that will greatly benefit the future of the company. With this said, we also believe that the greatest risk factor in the current standing of the company is weak management. In conjunction with our above noted reasoning for ATL's high offer, we believe that the growth of the company is being held back by the lack of aggressive performance by the CEO and COO. With that said, for Chinos to perform independently as a standalone company, the growth strategy will need to be amended using current management, or Chinos could offer current management a golden parachute. The ATL offer provides a generous share buyout. We believe the shareholders will be more than placated with ATL's offer. If Chinos were to stay a standalone company, it is projected to have large growth potential in addition to having growth potential in their current low dividend. Their structure for your proposal first should include what is best for the company and the shareholders. In this scenario, our opinion with what satisfies the Martinez family contradicts what is best for the company. With this said, we believe that however you structure the proposal, a golden parachute of sorts should be provided to the Martinez family. We believe an aggressive growth strategy, either through ATL Capital, another equity firm, or as a standalone company, would be the most beneficial for the company and shareholders.
We'd like to take this opportunity to thank you for your time and consideration in hearing our recommendations. On behalf of all of us here at Investment Bankers LLC, we hope you found our assessment of value to your situation.